What if I told you that trying to beat the stock market is one of the biggest mistakes most investors make? And what if the secret to long-term wealth, recommended by the world's greatest investor, was actually simple? Before we dive in, please remember that this video is for educational purposes only and is not financial advice. My goal is to help you understand these concepts so you can make your own informed decisions. With that said, in this video, we are going to break down the single most powerful investment strategy for the average person: index fund investing. We'll cover what an index fund is, why it's the foundation of passive investing, and how it can help you build wealth over the long term. And yes, we'll get to that famous advice from Warren Buffett. Make sure you stay until the end, where I'll give you a simple, actionable step to get started. For decades, the traditional image of investing has been the sharp-suited expert on Wall Street, picking winning stocks and ditching losers. The goal was always to be smarter than everyone else, to find that hidden gem, that one company that's about to take off. We call this active investing. The problem? Study after study shows that the vast majority of professional money managers fail to beat the market over the long run. That's right. The people who do this for a living, with entire teams of researchers and supercomputers, consistently underperform a simple, automated strategy. If the experts can't do it, what chance does the average person have picking stocks on their lunch break? It's like trying to find a specific needle in a giant haystack. It's difficult, time-consuming, and the odds are stacked against you. There are two main reasons for this widespread failure. First, the market is incredibly efficient. With millions of participants all acting on information instantly, prices adjust almost immediately to new data, making it extremely hard to find an edge. Second, and more importantly, active management is a zero-sum game before fees. For every buyer who gets a stock at a great price, there has to be a seller. It's a 50-50 proposition. But after you subtract the high fees that active managers charge, it becomes a loser's game for the investor. So, what's the alternative? Instead of trying to find the needle, what if you just bought the entire haystack? This is the beautifully simple idea behind an index fund. First, let's define an index. An index is just a list of stocks that represents a slice of the market. The most famous one is the S&P 500. It's a list of 500 of the largest, most successful companies in the United States. Think Apple, Microsoft, Amazon, and Google. An index fund is a type of investment, like a mutual fund or an ETF, that's designed to do one simple thing: buy all the stocks on that list and hold them. Its goal isn't to beat the market, its goal is to be the market. Imagine trying to pick the single best apple at the grocery store. It's tough. You might pick a bad one. An index fund is like buying a pre-packaged basket that contains a small piece of every single apple in the store. You'll get the best ones, the worst ones, and all the ones in between. But on average, you'll get the average return of all the apples, which is exactly what you want. Or think of it like sports. Trying to pick individual stocks is like trying to guess which single player will be the league's MVP this year. It's incredibly difficult. An index fund, however, is like placing a bet on the success of the entire league. You profit as long as the sport as a whole continues to grow and thrive, regardless of which individual players shine or get injured. This simple strategy has two built-in superpowers. The first is instant diversification. Diversification is the golden rule of investing. Don't put all your eggs in one basket. When you buy a single share of an S&P 500 index fund, you instantly own a tiny piece of 500 different companies across dozens of industries: technology, healthcare, finance, consumer goods, and more. If the tech sector has a bad year, maybe the healthcare sector does well, and it balances out. Because you own a tiny slice of so many companies, the failure of one single company has a minimal impact on your overall investment. This automatically reduces your risk compared to owning just a handful of individual stocks. The second superpower, and this is the most important one, is incredibly low cost. Remember those active fund managers who try to pick winning stocks? They have huge salaries, fancy offices, and teams of analysts. All of that costs money, which is passed on to you in the form of higher fees, or what's called an expense ratio. These fees might seem small, maybe 1 or even 2% per year. But they act like a constant drag on your returns, compounding over time and eating away tens or even hundreds of thousands of dollars from your retirement nest egg. Index funds, on the other hand, are passively managed. There's no genius stock picker making decisions. A computer simply follows a rule: own the stocks in the index. Because of this simplicity, the expense ratios for index funds are incredibly low, often just a few hundredths of a percent. Let's make this real with a quick example. Let's say you invest $10,000 and add $500 a month for 30 years. Let's assume the market returns an average of 8% per year. Investor A puts their money in an actively managed fund with a 1% expense ratio. Their net return is 7%. Investor B puts their money in an S&P 500 index fund with a tiny 0.04% expense ratio. Their net return is 7.96%. After 30 years, Investor A with the high-fee fund would have about $620,000. Not bad. But Investor B with the low-fee index fund would have about $738,000. That's a difference of over $118,000. It's a brand new car, a down payment on a house, or several extra years of retirement. That is the devastating power of high fees, and it's the incredible advantage you get by keeping costs low with index funds. And that powerful endorsement from Buffett is what helps so many people finally understand the magic of this approach. By the way, if you're finding this breakdown valuable and you appreciate this clear, in-depth approach, a quick click of the subscribe button below is the best way to let me know. It helps this channel continue to create helpful content just like this. Now, let's talk about how this all comes together in the real world. This brings us to Warren Buffett, arguably the greatest investor of all time. He built his fortune by making brilliant active investments. But what does he recommend for almost everyone else? Index funds. He has consistently said that for the vast majority of people, a low-cost S&P 500 index fund is the best investment they can make. In his 2013 letter to Berkshire Hathaway shareholders, he revealed the instructions he left in his will for the money he leaves to his wife. He wrote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. When the most successful active investor in history tells you that the best path is passive investing in an index fund, it's worth listening." Now, you might have some questions. A common one is, isn't this approach kind of boring? And the answer is yes, absolutely. And in investing, boring is beautiful. The goal of long-term investing isn't entertainment or the thrill of a gamble. It's the slow, steady, and predictable compounding of your wealth. Index funds turn investing from an exciting and often stressful casino game into a systematic, get-rich-slowly plan. Another question is, but won't I miss out on the next Tesla or Amazon? And yes, you will not get the explosive 1,000% return from a single stock. But you also will completely miss the next Enron, the next WorldCom, the next company that seems unstoppable until it goes to zero. For every big winner, there are countless failures. The index fund captures the upside of all the winners combined, while heavily protecting you from the complete wipeout of the losers. Finally, people ask, what happens when the market crashes? This is crucial. Index funds will go down when the entire market goes down. There is no escaping that. But history has shown that over the long run, the market has always recovered and gone on to new highs. An index fund strategy requires discipline. It means you keep investing even when it's scary because you are confident in the long-term growth of the overall economy. Panicking and selling during a downturn is the single biggest way to destroy your returns. So how do you actually buy one? It's simpler than you think. Most major brokerage firms offer index funds. You've probably heard of companies like Vanguard, which was founded by John Bogle, the man who created the first index fund for individual investors. Today, you can easily open an account with firms like Vanguard, Fidelity, or Charles Schwab. Inside your account, you would look for an S&P 500 index fund. They come in two main flavors: mutual funds and exchange-traded funds, or ETFs. For most beginners, ETFs are very easy to buy and sell, just like a stock. You would look for an S&P 500 ETF with ticker symbols like VOO or IVV, or a mutual fund equivalent like VFIX. You simply decide how much you want to invest, and with a few clicks, you become a part owner of 500 of America's top companies. So we've covered how trying to pick individual stocks is a losing game for most people, and how index funds offer a simple, powerful solution. By buying the entire market, you get instant diversification and dramatically lower costs, which are the two secret ingredients to long-term investing success. You're harnessing the power of the entire economy, letting it work for you over time, without the stress and high fees of trying to outsmart everyone else. To make this practical, here is your one assignment. This week, go to the website of a major brokerage firm like Vanguard, Fidelity, or Charles Schwab, and just look up their S&P 500 index fund or ETF. You don't have to buy anything. Just look at its information page. See the expense ratio. Look at the list of companies it holds. The goal is simply to make this concept real for you, to see how accessible it truly is. If this is the kind of practical, detailed analysis that you find valuable, and you want to continue making your financial life simpler and more effective, the best way to support this channel and see future content is to subscribe. To do that, just click the subscribe button right below this video and be sure to turn on notifications. Thank you for your time and attention today, and I look forward to seeing you again.